Good day. Thank you for joining me. I'm Ryan Kun, and I'm going to be taking you through Heineken's full year 2018 results. The Heineken international brand is well positioned to exploit the long-term trend of premiumization. Trading conditions are expected to remain volatile due to uncertain economic conditions, due to the company operating in a lackluster global economy with a muted expectation of growth. Selective price increases, innovation in products, and the pursuit of operational efficiency will become increasingly important to sustain earnings growth. Historically, the group has benefited from top-line growth and healthy margin expansion. This, coupled with good cash conversion and low balance sheet risk, has enabled Heineken to sustainably increase earnings and dividends. Revenue growth is expected to be maintained, while further margin expansion is expected. Improvements in product mix and further acquisition synergies from Brazil should be sufficient to offset increasing cost pressures. The current valuation is in line with comps, but we remain concerned about the valuation of the staples sector in general. We feel the share is fairly valued on a relative basis, trading at a forward PE of 20.89 times and a dividend yield of 1.7%. Heineken's return on equity has increased recently due to greater revenue and cost management. The return of invested capital over weighted average cost of capital has remained just below 1 since 2013. This indicates that the company has not been creating the value that is required. As a result, we recommend a neutral recommendation. Looking at some financial highlights. Revenue rose 4% with organic growth of 6.1%. This was due to a volume increase of 4% and a favorable price mix. Adjusted operating profit increased by 7%. The growth was driven by a surge in revenue and better cost management, which offset the commodities and input cost inflation. Diluted adjusted earnings per share increased by 23% to 392 cents per share. Heineken's full-year dividend increased by 9% to 160 cents per share, to the upper range of its target dividend payout ratio of between 30 to 40%. Moving on to the cash flow. Cash flow from operations, including working capital, increased by 13%. CapEx increased by 11% due to investments in Mexico, Vietnam, Brazil, and South Africa. Free cash flow increased by 14%. As a result of the free cash flow, Heineken has the ability to pay dividends without negatively affecting the operations of the company. The free cash flow amount is consistent and sustainable, therefore we do not anticipate difficulty in paying dividends. Looking at the balance sheet, Heineken's total debt decreased by 2.5% and the net debt to EBITDA ratio decreased to 2.3 times, below the long-term target ratio of 2.5 times. These results indicate that Heineken is currently deleveraging the company's balance sheet, as corroborated by the lower net debt to equity ratio, which decreased from 97% in 2017 to 84% in the current financial year. Given the cash flow generation and the profitability of the company, we feel debt levels are not problematic and the balance sheet risk is low. Looking at a few prospects. Management expects mid-single-digit growth in operating profit. This would be driven by volume, price, and premiumization growth, while mid-single-digit growth in input and logistics costs will add pressure to the margins. CapEx is expected to increase by 5%, which is in line with the previous year's maintenance CapEx. The continued rollout of Heineken 0.0 in combination with the continued growth of the premium portfolio will aid to the company's growth. If you would like to place a trade, please speak to your financial advisor or contact the trading desk. A comprehensive company analysis report can be found on PSG Wealth's online trading platform. Before we end off, please take note of the following disclaimer. Thank you.